All right, let's break down the latest earnings report from Synopsys. On the surface, their Q1 numbers looked fantastic. But then you look at the stock, and it dropped almost immediately. It's one of those classic beat and drop situations, and in this explainer, we're going to dig into exactly why that happened. And right away, you can see the paradox. I mean, they beat on earnings per share by 21 cents and topped revenue estimates by $20 million. That's a solid win by any measure, right? But then, the market's reaction? The stock sold off, dropping as much as 6% in after-hours trading. So the big question is, what did investors see that the headlines completely missed? Okay, so first up, let's just quickly run through the headline numbers, the stuff that made this quarter look like such a success story on the surface. And look, the scale here is just massive. We're talking revenue hitting $2.4 billion. That's a 65% jump from last year, mostly because the new Ansys business is now in the mix. The beat is crystal clear. If you were only looking at this table, that stock drop would make absolutely no sense at all. So if the headline numbers were so good, what gives? Why did the stock actually fall? Well, it really boils down to three core concerns that were hiding just beneath the surface, and frankly, investors couldn't look past them. So here are the three big culprits. First, there was a really noticeable slowdown in their super high-margin design IP segment. Second, you've got this ongoing revenue pressure from China because of all the export restrictions. And third, there's the massive $35 billion debt load from the Ansys acquisition, which is creating this huge financial overhang. All right, let's tackle concern number one. You gotta understand, the design IP business is absolutely critical for Synopsys. It's their high-margin growth engine. So seeing revenue in that segment actually fall by over 6% year over year, well, that was a major red flag for Wall Street. Management tried to soften the blow, calling it a transitional year for IP, but the market hates seeing a key growth driver go into reverse, even if it's just temporary. Now, the second big problem is China. And here's the thing, the company isn't hiding it. The CFO said it right there on the call. If you take out the new Ansys revenue, the core Synopsys business in China is actually shrinking. These geopolitical headwinds aren't some abstract problem. They are having a direct negative impact on organic growth. And finally, we have to talk about the elephant in the room, the $35 billion it costs to buy Ansys. Strategically, this deal could be a home run, but financially, it puts a mountain of debt on the balance sheet. And that leverage means the company has way less financial flexibility. You can bet investors are going to be scrutinizing their cash flow and execution like hawks to make sure they can handle this burden. Okay, so with those three big concerns swirling around, all eyes turn to the forward guidance. This was management's chance to calm everyone down, and the tone they gave was, well, let's call it cautiously optimistic. And here's the guidance for the next quarter. Yeah, both revenue and EPS came in a little bit ahead of what analysts were expecting. But here's the key. Slightly ahead just wasn't going to cut it this time. With all those other worries, investors needed a blowout forecast to get excited, and instead, they got a pretty cautious outlook that basically confirmed, yep, we've got some near-term challenges. So where does that leave us? What's the next call here? Let's get into our rating and what you should really be watching for going forward. Really, the entire story from here on out boils down to one simple question. What are the key catalysts that could actually move the needle for this stock? Okay, so here's what's on our watch list. First, execution on that Ansys integration. They have to prove that the massive price tag was worth it by delivering real revenue and cost synergies. Second, any shift in China policy, for better or for worse, is going to be a huge stock mover. And third, and this might be the most important one, we need to see a clear re-acceleration in that IP segment. If they can get that engine growing again, it would calm a lot of fears. So after all that, where do we land? We're officially rating Synopsys a market perform. Look, the core business is an absolute fortress, and long-term, that Ansys deal is probably a game changer. But right now, the weakness in IP, the China issues, and that mountain of debt just create too much uncertainty. For us, the risk and reward feel pretty balanced at the moment. All right, just for fun, let's put on our analyst hat for a second and pitch a potential trade idea based on this quarter. And I have to be super clear, this is for discussion and educational purposes only. The idea here would be a Paris trade. You go long Synopsys stock, while at the same time shorting the big software ETF, which trades under the ticker IGV. So what's the thesis? Well, you're trying to isolate the Synopsys specific story. If they execute well on the Ansys deal and that IP business bounces back, the stock should do great. By shorting the broader software ETF, you're hedging against some big macro issue that could pull the whole sector down. You're basically betting on Synopsys' execution, not the overall market environment. So that wraps up our breakdown of Synopsys' pretty complicated quarter. It's a complex story for sure, but definitely one worth keeping a close eye on. And as always, this is not financial advice.